The signal they told you to ignore is now screaming. For years, economists warned about sovereign debt. For decades, analysts cautioned that interest payments would eventually consume government budgets. For a generation, voices in the wilderness predicted that the bill would come due. The mainstream dismissed them as doom and gloomers. The central bankers assured us that debt didn't matter. The politicians promised that growth would solve everything. They were wrong. On January 21st, 2026, gold smashed through $4,174, $20 per ounce, a new all-time high. And the reason for this move is not speculation, it is not safe haven buying, it is not geopolitical uncertainty, it is mathematics. The sovereign debt Black Swan has arrived. That phrase is not mine. It is the title of an emergency note released this morning by the World Gold Council. The most authoritative body in the gold industry has officially declared what the market has been pricing in for months. The system is breaking. The United States national debt has topped $38.4 trillion. The bond market is in freefall. And the elite, the central banks, the sovereign wealth funds, the billionaires, they are panic buying gold at a pace not seen in modern financial history. Not gradually, not cautiously, with urgency that the financial media cannot explain and will not report. BlackRock's iShares Gold Trust recorded $4.2 billion in inflows yesterday alone, the largest single-day volume in its history. The People's Bank of China and the Reserve Bank of India are buying bullion off-market at premiums of $50 over spot just to secure immediate delivery. The 20-year Treasury bond ETF saw record outflows as investors flee sovereign debt. The smart money is not debating whether the sovereign debt crisis will arrive. They are sprinting to safety. And gold at $48.74 is their verdict on the future of paper money. Welcome to Chronicles of Currency. The sovereign debt Black Swan has arrived. The elite are panic buying. And this is just the beginning. Let me show you exactly what is happening. I'm your host, and this is the channel where we decode the monetary signals that reveal where the financial system is heading. We trace the patterns that the mainstream refuses to acknowledge. What I'm about to present is based on verified reporting from Bloomberg, the Financial Times, Kitco News, and official World Gold Council releases from this morning. This is not speculation. This is history being written in real time. On January 21st, 2026, gold broke through $4,174.20. Simultaneously, the bond market experienced what Bloomberg is calling a massive capitulation, and the World Gold Council released an emergency note with a title that should send chills down your spine. The sovereign debt Black Swan, that is their phrase, not mine. The most authoritative institution in the gold industry has officially declared a sovereign debt crisis. In this video, I'm going to walk you through exactly what happened on January 21st. I'm going to show you the rotation out of bonds and into gold that is reshaping global finance. I'm going to reveal the panic buying by central banks and institutions that is driving this historic move. And I'm going to explain why this moment represents something far more significant than a single-day price spike. This is the beginning of a monetary regime change. The correlation between gold and yields has broken. The market is questioning the solvency of sovereign issuers, and the only protection is hard money. Let me walk you through exactly what happened in the early hours of January 21st, 2026, because the coordination of this move across multiple asset classes tells you everything about how fundamental this shift is. At 8:42 a.m. Eastern Time, Bloomberg Markets published a breaking story with a headline that should have been on every front page in America. Bonds sell off as gold breaches $4,800 on debt spiral fears. Treasury yields surged to fresh yearly highs. Investors aggressively rotated out of sovereign debt. Gold spot prices hit a record $4,174, $20 per ounce. But it was what happened beneath the surface that truly reveals the magnitude of this moment. Mike McGlone, one of the most respected commodities strategists in the industry, explained what is happening in terms that should terrify anyone holding paper assets. The correlation between yields and gold has broken. Normally, higher yields hurt gold. Today, they are rising together. That is the classic signal of a sovereign credit event. The market is questioning the solvency of the issuer, not the opportunity cost. Let me repeat that. The market is questioning the solvency of the issuer. The issuer is the United States government. The market is questioning whether the United States can pay its debts. This is not a fringe opinion from a gold bug newsletter. This is a Bloomberg-quoted commodities strategist describing a fundamental shift in how the market perceives American sovereign credit. The flows confirm his analysis. BlackRock's iShares Gold Trust, the IAU, recorded $4.2 billion in inflows on Tuesday alone. That is the largest single-day volume in the entire history of the fund. Meanwhile, the 20-year Treasury bond ETF, the TLT, saw record outflows. Investors are not just buying gold. They are selling government bonds to buy gold. This is not rebalancing. This is capitulation. But the institutional flows are only half the story. At 10:15 a.m., Kiko News published a report that reveals what is happening behind the scenes among the world's central banks and sovereign wealth funds. The headline, "The Black Swan is here. Central banks panic buy gold at Fort House's $800. The word panic is rarely used to describe central bank behavior. Central banks are supposed to be calm, methodical, bureaucratic, but the data leaves no room for other interpretation. As gold smashed through Fort House's $800, reports surfaced that the People's Bank of China and the Reserve Bank of India have been buying bullion off-market at premiums as high as $50 over spot. $50 over spot, just to secure immediate delivery. A London-based vault operator was quoted explaining what is happening. This is a squeeze on physical deliverability. The elites and sovereign funds are not buying paper futures. They are demanding allocated bars. They want the metal out of the banking system. Think about what that means. The People's Bank of China, which manages $3 trillion in reserves, does not trust the banking system to hold their gold. The Reserve Bank of India, responsible for one of the world's largest economies, does not trust paper promises. They want physical metal in their vaults, under their control, and they are paying $50 premiums to get it immediately. This is the behavior of institutions that see a crisis coming. Not a slowdown, not a recession, a crisis. The World Gold Council confirmed this assessment in their emergency note titled "The Sovereign Debt Black Swan." According to the WGC, the weaponization of the US dollar via the new Greenland tariffs has accelerated the timeline for global de-dollarization. The dollar index is surprisingly falling despite high interest rates. In a normal world, high rates support currency values. Today, the dollar is falling because confidence in the issuer is evaporating. Gold has become, in the WGC's words, the only neutral reserve asset left standing. The only neutral reserve asset. That is the official assessment of the world's most authoritative gold institution. Not one option among many, the only one left. Let me explain the catalyst that accelerated this crisis into a full-blown panic. The Financial Times published their analysis this morning with a headline that captures the stakes. US-EU trade war trigger, Greenland ultimatum rattles global supply chains. President Trump's tariffs on European nations. The 10% levies starting February 1st, escalating to 25% by June, if Greenland is not sold to the United States, have done more than rattle markets. They have triggered what the FT calls a catastrophic fracture in global supply chains. But this is not just about trade policy, it is about resources. Greenland is home to the Kvanefjeld deposit, one of the world's largest undeveloped sources of rare earth metals and silver. These materials are critical for the European Union's green energy transition. Solar panels need silver, electric vehicles need rare earths, wind turbines need neodymium, and the United States just threatened to cut Europe off from the supplies they need. A diplomat in Brussels was quoted explaining the stakes. This is effectively a resource blockade. The US is using its trade leverage to corner the market on silver and neodymium. A resource blockade. Between allies. This is not Cold War rhetoric. This is the language of economic warfare between nations that have been partners for 80 years. The uncertainty has caused what the FT describes as a run on the bank for physical commodities. Industrial buyers who actually need silver and rare earths to manufacture products are now competing with speculative investors. Both groups are bidding up prices to historic highs. Silver touched $95.78 this morning. Gold is nearing $4,900. The Greenland ultimatum has achieved something that years of monetary policy could not. It has broken the trust that underpins the global trading system. And when trust breaks, capital flees to safety. The safety is not treasury bonds. Not anymore. The safety is gold. The World Gold Council's emergency note connects these dots explicitly. The weaponization of the dollar through tariffs has accelerated de-dollarization. Countries that once held dollars as reserves are now asking themselves, what happens when the United States turns those dollars into weapons against us? China is asking that question. The European Union is asking that question. India, Brazil, Saudi Arabia, they are all asking that question. And the answer is gold. Gold cannot be sanctioned. Gold cannot be frozen. Gold cannot be weaponized. Gold is neutral. And in a world where the dollar has become a weapon, neutrality is priceless. The dollar index is falling despite the highest interest rates in 20 years. This is the market's verdict on dollar credibility. The correlation between yields and gold has broken. This is the market's verdict on sovereign solvency. The Greenland tariffs did not create the sovereign debt crisis, but they exposed it. They revealed that the United States is willing to use economic warfare against its own allies. And if they will do it to Europe, they will do it to anyone. This realization is driving the panic buying. Central banks are accumulating gold because they see a world where the dollar can no longer be trusted. And that world has arrived. Let me show you the underlying mathematics that made this crisis inevitable. Yesterday's Treasury report confirmed that U.S. national debt has topped $38.4 trillion. But the debt itself is not the crisis. The crisis is what Bloomberg calls the fiscal risk premium. The bond market is now demanding higher yields to hold U.S. government paper, not because of inflation expectations, because of credit risk. The market is treating U.S. Treasuries like they have default risk. This has never happened before. For 80 years, Treasury bonds have been the foundation of global finance, the risk-free rate, the benchmark against which all other investments are measured. That foundation is cracking. Mike McGlone's analysis is devastating. Normally, higher yields hurt gold. Today, they are rising together. That is the classic signal of a sovereign credit event. A sovereign credit event, the polite term for a government that cannot pay its debts. Let me show you the numbers that justify the market's concern. Annual interest payments on the national debt now exceed $1.4 trillion. That is more than the defense budget, more than Medicare, more than every discretionary program combined, and it is growing exponentially. $9.2 trillion in Treasury debt matures in 2025 and 2026. This debt was issued when rates were near zero. It must be refinanced at today's rates of 4.5% to 5.5%. The additional interest cost, approximately $276 billion per year. By 2027, annual interest payments will exceed $2 trillion. By 2030, they could approach $2.5 trillion. At $2.5 trillion, interest payments will consume 35% of all federal revenue. 35 cents of every tax dollar going to bondholders. Not to services, not to defense, not to infrastructure, to interest on debt already spent. This is the mathematical reality that the bond market is pricing in. And the conclusion is inescapable. The debt cannot be paid off. There is no political will. The debt cannot be inflated away without destroying the currency. The debt cannot be defaulted on without crashing the global financial system. The only path forward is perpetual money printing. And when investors understand that money printing is inevitable, they buy gold. The $4.2 billion that flowed into BlackRock's gold ETF on Tuesday represents sophisticated institutional investors reaching this conclusion. The record outflows from Treasury bond ETFs represent those same investors abandoning sovereign debt. The rotation is happening in real time, and it is accelerating. The World Gold Council's Sovereign Debt Black Swan note is not a prediction. It is a diagnosis of a condition that has already arrived. Let me walk you through where gold prices are headed based on the world's top analysts. Near-term target, $5,000. With gold at $48.74, the $5,000 level is less than 3% away. Citigroup forecast last week that gold would reach $5,000 within 3 months. That forecast was made before the sovereign Debt Black Swan was officially declared. The timeline may now accelerate. JP Morgan Chase predicts gold will average $5,055 in Q4 2026, with potential peaks reaching $5,200 to $5,300. JP Morgan calls gold their highest conviction long bet. When the largest bank in America declares gold their highest conviction trade, while the World Gold Council declares a sovereign debt black swan, pay attention. Goldman Sachs projects $4,900 by year end, with warnings that gold may exceed $5,000 if Federal Reserve independence is compromised. Bank of America has raised their 2026 target to $5,000. The institutional consensus is overwhelming. $5,000 gold is not a question of if, it is a question of when, and when appears to be weeks, not months. 2026, extreme target $6,000. Peter Schiff predicts gold could reach $6,000 in 2026. Particularly as the sovereign debt crisis intensifies. Given that the World Gold Council has now officially labeled this a Black Swan event, Schiff's extreme scenario appears increasingly mainstream. 2028 target, $9,000. Tom Bradshaw's analysis from his recent interview with ITM Trading projects gold reaching $9,000 per ounce by 2028. When gold changes its value by 38% or more in a year, the American economy experienced serious economic crises, Bradshaw explained. Gold has reached this threshold in 11 of the last 15 months. Bradshaw's model is based on historical patterns that preceded the 1973-75 recession, the double recession of the early 1980s, and the 2008 crisis. The precious metals rally signals not prosperity, but alarm that the fiat currency system is under enormous pressure. His $9,000 target is not fantasy. It is the mathematical consequence of sovereign debt dynamics meeting the immutable laws of compound interest. But Bradshaw warns of volatility along the way. I expect a 40-45% correction, then a return to growth. A 40-45% correction from $5,500 would take gold back to the $3,000 to $3,300 range. That correction, if it comes, would be the buying opportunity of a generation. The physical premium signal. The most bullish signal is coming from the physical market. Central banks are paying $50 premiums over spot to secure immediate delivery. When the People's Bank of China is willing to pay $4,124 for gold that the screen says is worth $4,174, that tells you the screen price is wrong. The physical market is pricing in scarcity that the paper market hasn't fully recognized. This premium is the market's way of saying that $4,174 is too cheap. The real price, the price for actual metal in your possession, is already approaching $4,925, and it's climbing. Now let me explain what the mainstream financial media is not telling you about this historic move. They are reporting gold's rise as a reaction to Greenland tariffs. They are missing the structural reality. Here is what they are hiding. Hidden truth. 1. This was predictable. The sovereign debt crisis did not arrive suddenly. It was mathematically inevitable the moment the Federal Reserve began monetizing government debt in 2008. Every dollar printed delayed the crisis, but made the eventual reckoning larger. The debt has compounded for 18 years. The bill has arrived. Hidden truth 2. The elite knew first. The London Vault operator quoted by Kitco said it plainly, "The elites and sovereign funds are not buying paper futures. They are demanding allocated bars. They want the metal out of the banking system." Out of the banking system. They don't trust the banking system. The same banking system that holds your 401k, your pension, your savings. The elite are extracting their wealth from that system and converting it to physical gold. They are not telling you to do the same. In fact, the mainstream media continues to call gold a barbarous relic, even as central banks accumulate at the fastest pace in 60 years. The information asymmetry is deliberate. Hidden truth 3. The dollar is being abandoned. The World Gold Council note states explicitly that the weaponization of the US dollar via the new Greenland tariffs has accelerated the timeline for global de-dollarization. The dollar is losing its reserve currency status, not in some distant future. Now, the dollar index is falling despite the highest interest rates in 2 decades. This is unprecedented. It means that foreign holders are selling dollars regardless of yield. They don't want the interest, they want out. Hidden truth. 4. Physical is separating from paper. The $50 premiums that central banks are paying reveal a market that is fracturing. The paper price, set by futures contracts, says gold is $4,174. The physical price, what you actually pay for metal in hand, is $50 to $100 higher. This gap will widen. When paper promises can no longer be trusted, only physical possession matters. The elite understand this. That is why they want their gold out of the banking system. That is why they are paying premiums for immediate delivery. They are preparing for a world where the paper price becomes irrelevant. Are you? Let me project what unfolds over the coming days, weeks, and months. Immediate term, next 72 hours. The market has just absorbed the World Gold Council's Sovereign Debt Black Swan declaration. This official acknowledgement from the industry's most authoritative body will bring new buyers. Institutions that were waiting for confirmation now have it. Gold could break $5,000 within days. The Financial Times reports that silver touched $95.78 and gold is nearing $4,900. The move from $4,874 to $5,000 is now less than 3%. February 1st. Deadline. The first round of Greenland tariffs takes effect on February 1st. If Europe retaliates, the trade war escalates. Each escalation will drive more capital into gold as the only neutral reserve asset. The EU Emergency Summit this week will determine the response. Mid-2026. The Fed's dilemma. The Federal Reserve faces an impossible choice. If they keep rates high, interest payments on the debt spiral further out of control, confirming the sovereign credit concerns. If they cut rates, inflation reignites, destroying dollar purchasing power. Either outcome is bullish for gold. The Fed's independence is already under political pressure. If that independence is compromised, Goldman Sachs projects gold will exceed $5,000. Late 2026. The $6,000 scenario. If the sovereign debt crisis intensifies, Peter Schiff's $6,000 target becomes achievable. The combination of de-dollarization, central bank buying, and institutional rotation could drive gold 25% higher from current levels. 2028. Bradshaw's $9,000. Tom Bradshaw's analysis projects $9,000 gold by 2028. This would require a full-blown sovereign debt crisis with massive monetary expansion. Given the trajectory of debt and interest payments, this scenario is increasingly plausible. The correction risk. Bradshaw warns of a potential 40-45% correction at some point in this bull market. This correction, if it comes, would be a buying opportunity of historic proportions. Do not be shaken out by volatility. The structural drivers, sovereign debt, central bank buying, de-dollarization, are not resolved by corrections. They intensify. If you have been accumulating gold, If you warned about sovereign debt while others dismissed your concerns, if you held your position through years of ridicule, January 21st, 2026 is your vindication. $4,874.20 per ounce. A new all-time high. The World Gold Council officially declaring a sovereign debt black swan. Central banks panic buying at $50 premiums. Record outflows from treasury bonds into gold ETFs. Everything you warned about is now happening. The mainstream is finally using the words you have been using for years. Debt spiral. Sovereign credit event. Black swan. These are no longer fringe terms. They are Bloomberg headlines. They are World Gold Council press releases. They are the language of the financial establishment. You saw this coming. You understood that debt cannot grow forever. You understood that interest payments would consume the budget. You understood that the only escape is currency debasement. And you acted on that understanding. The $4,874 price is your reward. But the real reward lies ahead. $5,000, $6,000, $9,000. These prices are not fantasies. They are the projections of major banks and respected strategists. The sovereign debt black swan you warned about has arrived. The World Gold Council has confirmed it. The elite are validating your thesis with every ounce they accumulate at $50 premiums. Hold your position, add on any corrections. The greatest wealth transfer in history is underway, and you are on the right side. Let me give you a specific action plan based on the current situation. Priority 1, do not sell into this rally. $5,000 is days away. $6,000 is plausible by year end. $9,000 is Bradshaw's 2028 target. Selling at $4,174 to lock in gains would be selling at the beginning of the move, not the end. The World Gold Council just declared a sovereign debt black swan. This is not the time to exit. This is the time to hold. Priority 2, understand the physical premium. Central banks are paying $50 over spot for immediate delivery. If you're buying, expect to pay premiums. Those premiums reflect the real market value, not the paper price. The paper price is a fiction. The physical price is reality. Priority 3, prepare for the correction. Bradshaw warns of a potential 40 to 45% correction. Keep cash or liquid assets available to deploy if gold corrects to the $3,300 range. That correction, if it comes, would be generational. Priority 4, consider geographic diversification. The London Vault operator said the elite want their gold out of the banking system. Consider why. If you hold gold in a bank vault or ETF, you hold a claim on gold, not gold itself. In a crisis, claims can be frozen, seized, or settled in cash. Physical possession or allocated storage in secure jurisdictions provides protection. Priority 5, add silver. Silver touched 95.78 today. It is outperforming gold on a percentage basis. Tom Bradshaw projects silver reaching $375 by 2028. A balanced precious metals portfolio includes both. Priority 6, monitor the bond market. The TLT outflows are the canary in the coal mine. If Treasury bond selling accelerates, gold will follow higher. Watch the yield curve. Watch auction results. Watch foreign central bank holdings. Each deterioration in the bond market is bullish for gold. Priority 7, ignore the mainstream. They will call this a bubble. They will predict a crash. They will tell you to take profits. They were wrong at $2,000, wrong at $3,000, wrong at $4,000. Follow the central banks, not the commentators. The People's Bank of China is paying $50 premiums. They know something the pundits don't. Let me leave you with this. On January 21st, 2026, gold closed at $4,874.20 per ounce. The World Gold Council released an emergency note titled The Sovereign Debt Black Swan. Central banks panic bought bullion at $50 premiums over spot. BlackRock's gold ETF recorded $4.2 billion in inflows, the largest single day in history. Record outflows from Treasury bond ETFs signaled a massive rotation. And Mike McGlone, one of the most respected voices in commodities, declared that the market is questioning the solvency of the issuer. The issuer is the United States government. This is not a drill. This is not a temporary spike. This is the beginning of a monetary regime change. The 80-year experiment with unbacked fiat currency is entering its terminal phase. The $38.4 trillion national debt has crossed into crisis territory. The interest payments are consuming the budget. The only escape is money printing. And gold is the protection. The elite understand this. They are panic buying at premium prices. The central banks understand this. They are accumulating at the fastest pace in 60 years. The World Gold Council understands this. They just declared a black swan. Now you understand it too. $5,000 gold is days away. $9,000 gold is Tom Bradshaw's 2028 target. The sovereign debt black swan has arrived. Position yourself accordingly. This is Chronicles of Currency. Gold has reached $4,874. The elite are panic buying. The crisis is here. I'll see you on the other side. If this analysis was valuable, subscribe and hit the notification bell. I'll be tracking the sovereign debt crisis and gold's response as events unfold. Drop a comment. Do you believe $9,000 gold is possible by 2028? Are you positioned? Share this video with someone who needs to understand why the World Gold Council just declared a Black Swan event. The crisis has arrived. The countdown to $9,000 has begun. Chronicles of Currency, out.